The key to successful Forex trading is to have a good command of candlestick charts. I will give you a detailed introduction on several reversal patterns next. Reversal pattern can be classified by the number of candles, like single candle, double candles, and triple candles. More candlesticks usually indicate a stronger trend of reversal. Let's start with the single candle reversal pattern. Doji. A doji is a candlestick with only upper and lower shadows and without a real body. It forms when the opening and closing prices are at the same level. It graphically looks like a star. Generally, a doji means the power of long and short arrives at a balance. There are different types of the doji, each with its own meaning. They include the long-legged doji, dragonfly doji, gravestone doji, and four-price doji. Long-legged doji. The long-legged doji is made up of a long upper and lower shadows, just like long legs. It indicates that buyers and sellers attempted to push the price higher and lower, but the two had the same trading power, leading to a similar opening and closing price. Dragonfly doji. A doji with a long lower shadow and short or no upper shadow is called a dragonfly doji. This is because it graphically looks like a dragonfly. It indicates that sellers tried to push the price lower, but the buyers fought back and pushed the price back to the opening price. Gravestone doji. The gravestone doji is the opposite of the dragonfly doji. Its real body is below the shadow, and its long upper shadow resembles an erect gravestone. It shows that buyers tried to push price higher, but sellers fought back and pushed the price near to opening price again. Four-price doji. It is referred to as the four-price doji, for it has no or short upper shadow and lower shadow like Chinese character 1. It indicates that the opening price, closing price, the highest price, and the lowest price are almost the same. While the length of the doji is important, we should pay more attention to its location. In most cases, when a doji appears at a high or at a low point, it is usually a sign of reversal. For example, when a doji appears at the top in a continuous raising trend, it is a signal of top reversal. Then you can place a sell order, but you should also remember setting stop loss at the top of the doji's upper shadow. Once the stop loss is triggered, this reversal can be considered as invalid. On the contrary, when a doji appears at the bottom in a continuous downtrend, it is regarded as a bullish signal. In this case, we should place a buy order and set a stop loss at the bottom of the doji's lower shadow. Similarly, once the stop loss is triggered, this reversal can be considered as invalid. There are different styles of the doji, and they have different meanings at the location of the chart. Let's take a look at those three doji types. What are they respectively? What signal do they represent?
Both A and C are ordinary dojis, and B is gravestone doji. A and C appear in the middle of the trend, so they are not reversal signal. But B is at the top of the rising trend, so it is a reversal signal. Still, we can see a stop loss has been set on the top of upper shadow and would not be triggered. Thus, this is a valid signal.
Well done, a very good analysis. We usually set sell order in case B and set stop loss at the top of upper shadow. This will bring us substantial profit. The location of doji is quite important, particularly in the following cases. Hammer and hanging man. The hammer and hanging man patterns have little or no upper shadow, with a relatively long lower shadow, which should be at least twice the length of real body. The real body can be positive or negative.
Can we tell a hammer from a hanging man based on whether the real body of the candlestick is bearish or bullish? In other words, can the bearish candle be regarded as a hammer and the bullish candle be regarded as hanging man?
No, identifying them mainly relies on where they are in the chart. The hammer pattern is formed in a downtrend. It looks like a real hammer and sends a signal that the bear market is about to end. The long lower shadow of the hammer indicates that the underlying asset sold off sharply but demand returned, forcing the price back up to close at or near the high for that period. In this case, you should set a long order with a stop loss at the bottom of the hammer's lower shadow. If the price falls through the stop loss, it means that the reversal was invalid. A hanging man, on the other hand, sends a signal of a possible peak or a strong resistance. When it happens during an uptrend, it indicates that sellers are starting to outnumber the buyers. If the hanging man is a bearish candle, there is a high possibility that the price will start to fall, and it is the time to short the asset. However, if the price rises above the real body of the hanging man or at the top of the upper shadow, it means that the reversal was not successful. Let's review what we have learned. Which of these are hammer? 1 in 3 are hammers because they are in the downtrend. Before we answer this question, we need to make clear 2 important points. The first is whether the shape of its pattern meets its character, and the second is whether it is in a downtrend. Though one looks like a hammer, it's actually not, for a hammer must contain a long lower shadow twice the length of its real body. Therefore, only 3 is a hammer. The reversal of hammer and hanging man pattern is the inverted hammer and the shooting star. Inverted hammer and the shooting star. The inverted hammer is similar to the shooting star. The only difference between them is whether they are formed in an uptrend or a downtrend. The inverted hammer, as the name suggests, looks like a reversed hammer. It usually occurs in a downtrend, which indicates sellers have not enough power to push price lower. It is usually a sign of a reversal or a consolidation. The positive inverted hammer indicates higher possibility of reversal compared with negative hammer. If the price falls through the real body of inverted hammer or the bottom of lower shadow, it indicates an invalid reversal. Shooting star, as the name suggests, looks a star that appears at the top of uptrend. The shooting star pattern indicates that sellers have taken control of the trend, pushing the price near the opening price. When it happens in an uptrend, it signals that a trend is about to end or that there may be consolidation. If it is a negative shooting star, it signals that the price will possibly fall. If you place a short order at that position, you should set a stop loss at the top of the upper shadow. Now it's time to review what we have learned about the inverted hammer and the shooting star. Look at the following question and tell me your answer. If the marked position is a candle that looks like an inverted hammer, which one takes the highest possibility to rise after the marked position? That could be 2 and 3. In the pattern 2, the upper and lower resistance levels can be identified. X is right above the lower resistance, which is much more likely to start a reversal than number 3. 1 and 4 are called shooting stars, not inverted hammer. So 2 is correct.